Hello and welcome to Nirmal Bang, ladies and gentlemen. I'm Hiral Dadia. We have with us Ms. Keta Kurkute, Executive Director at United Financial Consultants, joining in. Keta, welcome to the show and a pleasure to speak to you and get insights from you. Keta, my first question coming to you right now is overall, if you see in terms of where the Indian rupee is concerned, there is some bit of consolidation that we are seeing right now because so far in the month, the rupee has shed, say, close to 1% against the dollar. I mean, yes, there are worries on the import bill that have been sparkled by hardening oil prices. And you have global central banks as well, which are increasingly taking and talking of tightening monetary policies. So, overall, what's the view that you have, firstly, on the Indian rupee?
What we have seen is Indian rupee, if you compare the start of the year from Jan onwards, we opened around 73.09 in the month of Jan, and today we are at 74.80, 86 roughly. That gives us an overall depreciation of close to 2.3%, whereas dollar index has strengthened by almost 4.4% in the same period. So we have seen a restricted depreciation in the rupee primarily because of the influx of funds. Last 3 to 4 months, even if you look at the dollar reserves, FX reserves of RBI, we are above 600 billion. We are at close to lifetime high. So the flows are very strong. So rupee is stuck between the positives of the flows as well as on the negative side. It is the hardening of the interest rate and the dollar index. So it is consolidating right now. Even in the next 2 months, we are expecting good amount of flows from corporate side, which is time and again pushing the rupee on the stronger bias. Today also, since yesterday, we have seen a good amount of appreciation in the rupee. Today is the second consecutive day. Rupee went to a high of close to 69, 74.69. And again, it is right now, it ended at close to 86, 74.86. So we are seeing a good amount of pressure on account of good flows. Having said that, there could be some pressure because oil is a main concern, as you rightly said. The oil bill would be a main concern, but we should not forget RBI's hand in the rupee's direction. RBI is always there in the market. They are always monitoring rupee. As compared to last year, we have a good amount of reserves this year, wherein if you see a depreciation, they can actually come in and they can use the reserves. On liquidity front also, reserves management would be easier for them to sell the dollars in order to control the rupee's depreciation, because sucking out of liquidity won't be a problem this time because ample of liquidity is there in the market, rupee liquidity. So they're in a much better position to intervene this time rather than the last year when the pandemic has hit the Indian economy on a higher side, and we have seen a lot of concerns on that front. So rupee, more or less, it would be range bound. We are not expecting rupee to make any new lows unless there is a crash in the equity market, which at this point of time, none of the central banks want to spoil the party. Even Fed is not very keen on raising the alarms. They have been very slow. So nobody wants to spoil the party in the equities. Until that time, you will see a very range bound rupee. You can expect one rupee movement on either side. So rupee would be consolidating, definitely. Till the end of December, we would be seeing a consolidation in the rupee.
Right. So overall, with all of this, another aspect that comes in is that there's a continuous rise that's coming in terms of global crude prices that we mentioned. And there is a concern that there is a possibility that the domestic inflation could go higher on the back of crude, and this could pressure the trade deficit. So do you think that's something which would actually change the way the rupee moves?
We have seen, we have hit just 2 months back, we were at 72.90. Okay, today we are at 74.80. So we have seen a depreciation. This depreciation, despite of the inflows, this depreciation has hit us primarily because of the crude, what you rightly said. So there is a crude factor is there. Interest rate hike, from today till the end of this financial year, we have only 2 RBI meetings in the month of December and in the month of Feb. Whereas Fed, we have 3 meetings till March. And market is already factoring that they could announce on the tapering part in the month of November. So this thing market is already factoring in. Unless you see a very definite pullback in the liquidity, I feel RBI will be there managing the currency. Moreover, what we have seen is since last couple of months, a lot of exporters are also selling. Bankers, foreign bankers are also using this uptick and they are selling dollar. So at this point of time, nobody has given, written down the rupee that it is going to weaken or give some new lows. Moreover, if you look at the economy per se, the actual economy, the data is on the brighter side. We are giving good numbers on PMI, on manufacturing index. Inflation is concerned not only in India, it is worldwide. It is in the Eurozone, it is in US, everywhere it is there. So the trigger will start of this inflation. Most probably, I feel it will start in the next year, in the first quarter. Till then, till December, market will play safe or they will be in a consolidation. They would take big positions only beginning 2022. When you see things, you get a much more clarity in inflation, because everybody feels that it is a transitory inflation, but there are supply demand mismatches, supply chain mismatches are there, which would take another 2 months for us to clarify. We will see some amount of pressure, but appreciation is ruled out. Despite of good inflows, we are expecting LIC IPO next financial year, or whatever the flows are there, we are not expecting a big appreciation. Appreciation would be restricted, but depreciation would be very slow. It will be staggered. It won't be all of a sudden the way we have seen in the last year.
Right. So overall, as we are mentioning that appreciation is something which is ruled out. So overall, even the recovery that we're seeing in the imports on the back, on the opening of the economy, what's the kind of current account deficit could we expect? Because on an average, the idea is that a 0.8% of GDP in FY22 that we could be looking at. And with the return to a current account deficit regime along with the impending taper, what is the kind of level are you expecting the rupee to trade with if you have to look at FY22 as a whole on an average?
Very difficult to say that because a lot of equations are there. But looking at the current crude prices, the way we are going to pick up, or a GDP, the way we are going to pick up, unless we see a abrupt crude price, because personally I feel there could be a correction in the crude price in another 2 to 3 months. We could see a correction because the prices are too high and a lot of speculation activities are going in the crude market, commodities market. I expect rupee to trade somewhere between 73.50 to 76 mark, which is an ideal level wherein importers as well as exporters. This is a level where both of them could hedge, because a lot of hedging instruments are there in the market. Even equities have opened up, so you have a lot of hedging instruments. So 73.50 to 76 is a level wherein both the parties are comfortable, and we could adjust on the current account and the trade numbers, because trade numbers are also bad this time on the account of higher crude prices, which could get adjusted. But close to 73, half 76 is a good level wherein rupee could make, it's consolidated in those levels.
Right. So, as you mentioned, an interesting point about importers and exporters. At what levels, according to you, should importers cover their imports? And at what level on the rupee should the exporters take their hedge? What would be that good level for them to look at?
Okay, a very good question. The entire thing depends on the risk appetite of importer as well as exporter. Moreover, it is what duration of hedging you are looking at. Okay, so in case we have been advising a lot of PSUs, we have been advising a lot of actual importers. Usually in India, imports are getting covered on an average period of 2 months, because dollar is a premium currency. One has to pay price for it. So imports, we have hedged close to 73 for the 2 months, but again now your 2 months will be opening post October. I feel that close to 74.50, 74.80. Those band is a very good band for importers to keep themselves hedged. You can have a hedging mechanism, staggered hedging mechanism for the next 1.5 months between that level, 74.50 to 74.80. Any 10 paisa lower than that, one should keep themselves hedged. Why I will tell you, November and December are the most riskiest month for the foreign exchange market. We usually see a high volatility in the month of November and the early December. So it is very difficult to time the market, what levels you will get. So it is prudent to keep yourself hedged for this 2 month at the dips at 74.80 below 80, 74.50 to 80 band. 2 months import should be covered. Exporters have covered in this opportunity of 75.35 plus. The last week was a very good opportunity for exporters, but you have not missed the bus. We will see a move close to 75 levels also again, time and again. So 75 exporters should capture some premiums and take small hedges for the next 3 to 4 months. So these are the levels one needs to actually look at the risk appetite, your costing levels, your cash flows, how you are anticipating for taking these hedges. So unless you have a very high risk appetite, you can keep it open, but no need to keep the entire portfolio open. At least a 50% hedges required for the months of November and December.
Right. And very lastly, overall, what's the kind of impact that you see with regards to where the bond markets go? And do you think it pins hopes on RBI announcing further OMOs?
Definitely a lot of bond market this time we are looking at a lot of big activities, primarily not only on the Indian context, but because of the US Treasury yields also. Yields have hardened overall. Market despite of central bank's opinion, market is expecting a tapering. And if you look at the yield also, we have seen a considerable rise in the yield. And like RBI in this recent monetary policy also, governor has mentioned that ample of liquidity is there. He is not in favor of putting more liquidity.
Correct.
He has been pressuring it because see, inflation is such a big it's a threat. That threat can rise suddenly, and RBI sometimes need to act in a very sudden manner. So nobody wants to take a risk on the inflation front. Inflation is really hardening up. So no fresh liquidity might be there in the market. Liquidity is ample. There would be pressure on the bond markets because no fresh liquidity is expected in the market. So they will be very cautious in pumping it any fresh liquidity. On the contrary, if they see any hardening, and they might pull out a small amount of money, and the trigger could be from the Fed on November 2nd and 3rd. So we have our meeting post Fed meeting. So a lot of clues will be taken from the Fed. So the entire onus will be on the Fed, how they take the market. But definitely a bond market will be an area to watch around for the next 1 or 2 months.
Right. So that's overall what happens as well. But thank you, Keta, so much for joining us on the show. Always a pleasure to speak to you. Great insights. And speak to you soon again. Thank you and stay safe.
Yeah, you too. Thank you so much.
Right.
Subscribe to our YouTube channel for in-depth interviews of India Inc. and press the bell icon so that you do not miss our updates.